Let's now go across to our special guest this morning, Dipen Sheth, Head Institutional Research at HDFC Securities. Dipen, it's great to have you on the show. Thanks very much for taking out the time. You're saying FY19 will be more volatile than FY18. What is your premise of holding that view?
So we've already had early indications of that in the last quarter of the trailing year, when we all got excited over the days in January leading up to the budget, and then we had that big crack coming all the way up to the end of March. Even from there, we've pulled back, some 700-800 points from the lows of late March. I think we got almost, as it were, some kind of a free ride coming out of demonet in December 16, and all of calendar 17 was almost like a one-way up move. And everything began to gradually fall into place into the markets, and we got a little complacent, especially in the time leading up to the budget. If you will notice that there is global uncertainty also picking up as well. So the lucky din, as I kept calling them, receded a bit with oil pulling back, and the structural risks in the Indian economy became all too evident all over again. So while we have pulled back from those lows of March, I think this entire mix of rising global interest rates, the prospect of monetary tightening in different ways, both in the Eurozone and in the US economy. So the Fed has signaled clearly for 2, maybe 3 rate hikes this year. The ECB is going to wind down its bond purchases even as it grapples with a less than Euro-friendly government prospect in Italy. So I think this is going to be a very interesting year, and for the reason that there are lots of pushes and pulls happening from different directions in India. Not everything is bad, though. We've gradually migrated into the GST regime. We've come back from the shock of demonetization. We are moving steadily towards formalization. This is an election year, so spends in rural India will increase. The monsoon so far looks good, touch wood. And I think consumption confidence has risen like never before. On the other hand, we are faced with this impossible trinity of the dismal science of economics, that we can't control currency, monetary policy and capital flows altogether. So I think it's going to be a very, very interesting year, and it's not going to be a trending market for sure.
Dipen, morning. How critical is the Trump-Kim summit currently underway in Singapore? And do you think, all expectations from world markets are that Kim Jong-un actually plans to denuclearize, and only that will make the markets happy? And would it in the first place? Because this seems like a more complicated process than it actually may turn out to be.
Yes, it's always more complicated than what the headlines would suggest, and you're asking me to figure out how Trump, who represents the kind of volatility that I've been speaking with, might take things forward with Kim, who represents the kind of, again, the kind of opacity and volatility that markets are all about today. So frankly, we cannot be sitting here in Bombay trying to figure out what Trump and Kim are going to be up to, although we must admit that it has a huge bearing on global capital flows. We are barely able to figure out the dynamics of our local politics here. So I don't think we should hazard guesses about where things might go. Of course, a positive outcome will be understood by us, but to be able to predict a positive outcome or to, kind of thump the table on a negative outcome are both ill-conceived endeavors, if I may put it that way.
Dipen, I'm not asking you to second guess what's going to come out of the summit. All I'm asking is that if North Korea does plan to denuclearize, is that going to make the markets happy?
Most certainly. I think it will be an incremental positive, and a fairly large incremental positive. But then there are other parts of, the geopolitical equation, as it were. So there's Turkey, which is now ruffling a few feathers with its recent pronouncements, and the Middle East is always in some kind of a potboiler, if I may say so. The fact that oil prices have risen to 70 plus not only indicates that Saudi Aramco is going to have a good issuance, but it also means that there are structural problems with large oil importers like India, who are right now 80-82% dependent on external supplies of crude. So it's, while the Trump-Kim outcome, if it's positive, will of course soothe some frayed nerves, I don't think it will completely send markets into some kind of runaway mode. Obviously, there is the tightening both by the US Fed and the ECB, like I said, in their different ways. So interest rate hikes in the US, stoppage or termination of bond purchases by the ECB over a period of the next few months will certainly keep interest rates high and monetary positions tight, which makes capital flows into emerging markets that much more difficult. Having said that, I think India is probably the most exciting emerging market in the current global context in terms of the sustainability of its growth. Like I said, we are moving towards more and more formalization in the economy, better tax compliance, and a structural shift towards rule-based governance rather than crony capitalism. Obviously, this is still a very large work in process, but the direction is clear, and I think foreign investors will use volatility this year in markets to begin investing or to aggressively invest in India all over again. But you can certainly see short-term outflows which can keep markets volatile. That's the net view.
These opportunities come by, especially at a time when, with the recent rate hike by the RBI, we've also joined the bandwagon of, tightening liquidity conditions. You've highlighted three themes, one, of course, being corporate capex recovery, which I would believe that there's value in the investment-led cycle and associated businesses. You've spoken about speedier IBC resolution, which again gives an opportunity window for banks and banks with bad or high NPAs, bad loans that is, and then cool off in crude prices, which has been such an impediment when it comes to figuring out what OMCs can do into the near future. So where is it that you spot that opportunity to generate alpha in this volatility?
Yeah, so I don't know what the next trigger for investors is going to be. If you're looking for a trigger, like you said, some policy action to stir corporate capex can certainly excite some of us who've been waiting for the corporate capex cycle to take off. Speedier IBC resolution, a crack in crude prices, obviously a structural positive. But then you have some things on the negative side as well. So you can obviously, like I alluded to that earlier, a sudden outflow of FPI money can certainly drive markets down, can impinge on currency stability. The recent bond raise plans from NRIs by the government, I suppose, is part of managing that sort of volatility. Rise in the global interest rate cycle, a major global risk of event such as failed talks between Trump and Kim, or some more little or not so little developments in the Middle East and in oil supplies. Obviously, so there's a whole lot of things, and it keeps on coming back to the same old thesis that I have, that things are going to remain volatile. India is in a much better position than it was maybe 5 years ago, and any long-term investor is going to use these short-term volatility to aggressively start taking positions into India. As for Indian retail investors, I think for those people who have made money, certainly some bit of profit taking is warranted. But then there are stable stocks in the market which you can use to withstand volatility, and even do a stock-based SIP if you want to. If you are subscribed to a mutual fund, you can continue with your SIPs through the volatile period, and that's actually how long-term wealth creation actually happens for retail investors.
The earnings cycle then, Dipen, if you are talking about there being volatility, what would that mean in terms of underlying earnings coming back to support the markets? Do you think FY19 would be the year when we would see earnings trending? And if so, what is the kind of ballpark range you expect?
So I doubt if we will see very high double-digit earnings in FY19. If we hit double digits, I think that should be good enough, because there are lots of parts of the Nifty now, which are actually under some kind of stress. So the banking system, especially the large corporate banks, whether it's an SBI, BOB, or whether it's an Axis or an ICICI, are certainly struggling on this front. And I think even with the support of earnings, the OMCs, in case their earnings are left intact, but the sheer expansion in their balance sheets would call for some derating, and that's already visible in the way they've been behaving. However, there are large parts of the Nifty. If you look at some of the large caps, and if you look at some of the more stabler stocks, stocks which offer a very decent hedge, as it were, against the kind of volatility that we are looking at right now. So names like, a Hero Moto, which is coming off a sluggish phase of low volume growth, but did I think mid-teen volume growth last year, which is FY18, and is poised for 9-10% volume growth again over the next 2 years. A stock like Hero Moto comes to mind. A dominant player like ITC, which is available at probably its all-time high discount to the rest of the FMCG sector. We do agree that it should trade at a discount, but not this kind of a broad discount. So at 23-24x, you have ITC. At 16x, you have a Hero Moto. And if you feel that the currency, India's currency, is going to take a hit in the face of global capital flows turning volatile, then I think Infosys offers a very good hedge at about almost 25% discount as a dollar proxy, at a 25% discount to TCS. So as viewers will well recall, Infosys is rapidly getting into a phase where it's reviving its core franchise. There's a commitment for high payouts, and obviously the dollar proxy makes it a very, very decent hedge against volatility in markets driven by capital outflows. So there you are, three large caps, boring large caps, if I may say so, allegedly boring large caps, which offer a very decent position building opportunity over the next 1 year, as it were, as we enter markets which threaten to be volatile.
Well, it is the boring large caps which have been giving you all the returns so far this year. But Dipen, since you did touch upon Infosys, and not just Infi and TCSs of the world, given the way the currency has been moving, do you think that the tailwind is going to remain for IT as a sector, and perhaps one could stretch out our investments even to some of the mid-cap IT names too?
So actually, the big money, very large money, much more than the front caps, has actually been made in the mid-cap space. And by mid-cap, I actually mean a whole lot of companies which are almost at or around kissing the $1 billion mark as well. So L&T Infotech comes to mind, L&T Tech comes to mind, and Emphasis comes to mind, and there's a whole lot of stocks which are outside the top 4 or top 5. In the frontline IT stocks, obviously I've already mentioned Infosys, but then HCL Tech is even cheaper. So I think this big play on the dollar is one part of the IT story. For the last year or so, we've been thumping the table on IT, saying that it's too good a business to fade into oblivion. It has a longevity which is much more than what investors might think, especially in the face of the challenges that the movement to cloud and automation and AI and all of that was threatening to Indian companies, and we've never really believed that thesis. A lot of these companies have made significant investments in the digital space, have made significant investments in automation, and being able to free up productivity, and utilizations have jumped up by close to 1200 bips over the last year and a half. Many of these companies have swung back into relevance in the markets where they operate in, and have been able to maintain margins. And now I think it's the weakening rupee which will help them continue the good trend. I don't think this is a trend that is going to reverse over the next 1 or 2 years so easily.
And finally, what's the approach that you would take to the financials? Split it down between PSU banks after the meeting with the finance minister, private banks as well as NBFCs.
So NBFCs have had a dream run, as we know, and we are still gung-ho on many of them. Whether it's a Chola, for example, names like Chola come to mind. Some of the smaller banks come to mind. So we've been gung-ho on DCB and City Union Bank for a while. The larger truth in the financial space is that the government has repeatedly demonstrated its lack of capability in running large financial companies. There are notable exceptions here, of course. Despite all the headline pain, we still feel that a Bank of Baroda or an SBI, these are excellently managed organizations, and they've gone through cyclical downturns with a few hits and few misses, as it were. But the rest of the PSU bank space doesn't really offer much comfort. You might point out an exception like an Indian bank or something, but frankly, I think the gradual letdown in the gradual giving up of market share, as it were, in the credit space, in the lending opportunity in India by the PSU banks, and today they are close to 60, 62 or 63% of the system. I don't remember the exact number, but remember this started at about 100, and if this is going to be at 40% in 10 years from now, I don't think we should feel very sorry about that. Like I said, there are good PSU banks which deserve an investment position by long-term investors, but there's very little else to choose from, frankly. And if you want to be an investor in financials, then you need to look at some of the smaller banks. And like we've said, apart from a DCB or a City Union Bank, which we've been talking about for a while, we've recently covered RBL, headline valuations at about 2.7x or something on FY20 basis, look costly, but I think at 40,000 crores loan book and the ability to grow at 30-35% for the next maybe 5 years, maybe 10 years, with a very, very, very sharp and capable management. I was reading Mr. Ahuja's interview in the Economic Times recently, and I completely agree with him that growth is not going to be a challenge here. They've got a very good fix on asset quality. There have been a little there has been a little bit of vibration there, but I think headline net stress level at less than 90 bips, a bank growing at 30-35%, now aggressively growing out a retail franchise, aggressively garnering market share in the exciting cards business. A very, very good small business franchise also in the making, increasing granularity on the book, skin in the game with the management, 8% I think, outstanding ESOPs as at FY17, and we'll have to see their latest annual report for more on that. I don't think a long-term investor should look at short-term volatility in this stock, and you should just buy and lock up this stock for maybe the next decade or so.
Okay, Dipen, great speaking with you. Thank you so much for taking the time out and chatting with us and sharing with us your thoughts on the markets and where you find value in the market right now. Let's just revisit